I like to give you more. To get to give you more exposure, right? So the actual exam at 20 to 25, then you have the entire class. When you're done, you can leave. Okay? All right, so the best way to do this is to go over through the questions from the practice test. Now, because we don't have as much time, now if we already know how to do something, maybe we could skip it, right? I mean, right? Because I'd rather do the most important questions. All right, so we'll start with the first one. So if you know how to do the first one, then let me know so that we wouldn't be wasting too much time. And also, in terms of reading, we might take turn. Would you know how to do the first one, which is on page 2? Create a common size income statement for 2012. Say yes or no.
No, thank you.
You wouldn't know how to do it?
I'd like to go over it.
Sure, I mean, that's fine. So question 1 is a common size income statement. So the way to do this, you take each, so obviously this one is related to the income statement. And then you take each item or each figure from the income statement and you divide by sales, right? For example, the first one would be 3,756, is that correct?
Mm-hmm.
And then you divide by 3,756. Obviously, that will give you 100%, right? Make sense? And then you go to the next one. By the way, I want 2 decimal points with a percent, right? So then the next one, to get the next one, which is cost of goods sold, then you do 29.43 divided by 37.56, okay? And so on and so on. So what is the answer to that?
78%, 35.
Exactly. So it will be 78.35%. And then you go to the next one, which is depreciation, right? And then depreciation is 490 divided by 37.56. And then we get
13%.
13.05%. Okay, and then here we could get the earning before interest and taxes. So then that will be 323 divided by 37.56, or it will be this minus this minus this, right?
Right.
Either way, you should get about 860. Is that 860?
Mm-hmm.
Yeah.
And then we keep on going. Interest. So interest here will be 123 over 37.56. And then we get, is that 3.27?
Yes.
And then we get earning before taxes, which is 200, right? Divided by 37.56, and then we get 5.32. And then we go to taxes. So here taxes are 68, so 68 divided by 37.56, then we get 181%. And then now we can get net income. Net income here is going to be 132, right? Then divided by 37.56, or it is simply the difference between those two, right? Either way, we get 3.51%.
51.
And then we're done. That's our, common size income statement. Everything as a percent of sales. That makes sense? And then the second question is create a common size balance sheet for 2012. This time we divide all the different figures by total assets, right? So we pretty much do the same thing.
Right.
So shall we still do it?
No.
Right? So basically, we get the idea. Number 3. Now, what is the day sale in inventory for the company above in 2012? So days sale in inventory, this one will be the 365 divided by the inventory turnover, right? Does that make sense? All right, so let's do it. Days in inventory. So it's 365 over the inventory turnover, which is really,
7.99.
yeah, but well, how do we compute the inventory
Cost
turnover?
of goods sold.
It's the cost of goods sold
Divided by
divided by inventory. That's pretty much how you could also show your work, right? Does that make sense?
Yes.
It's 365 divided by cost of goods over inventory.
Because it is 365 divided by the inventory turnover,
Got it.
all right? But well, how do we compute the inventory turnover?
Taking the cost of goods.
That's right. So that's my inventory turnover, right?
Okay.
So therefore, you get 365 over,
2,943.
okay, you said how much?
2,943.
43 divided by
368.
368.
368, right? And then we get 365 divided by,
7.9973.
368.
okay? And then the whole thing gives you,
45.6.
and then we get 45.64?
Yes, yes. So we have to put like that, 45.64, 46 days.
Yeah, well, it's still okay to give me 2 decimal points, right?
Yes.
Okay. So it's 45,
640.
64 days, right?
Yeah. Yep. So,
So that's not too bad, right? Or what you could have done, step number 1 could have been the inventory turnover, and then step number 2, day sales in inventory. Or you could do it in one shot, right? Okay. Next. Now, what is the total asset turnover for this firm in 2012? Is that question 4?
yeah.
So Pat is going to be sales over total asset. Now, we know that sales here, sales are,
3756 from the block.
37, you said,
3756.
56? Over total asset,
6,048.
okay. So 6,048,
48.
and then what do we get? 0.6210,
10.
and then times, right? Is that what you got?
Yeah.
Yes, yes.
Yeah.
And then times, do not forget the unit. Does that make sense? So what is the next question?
The liability of sole proprietors is limited to the amount of their investment in the company. Circle 1, true, false, uncertain.
Yes, of course.
it's just limited to their investment in the company, that's false. In fact, we have in this case, we said they have unlimited liability. It goes beyond their investment in the fund. Even personal assets are also at risk, right? Does that make sense?
Yes.
Yeah. Next.
Sylvan Brother LLC paid $85,000 in cash for inventory on January 1st, 2006. On December 31st, 2006, the entire inventory had been sold. The company's sales orders totaled $97,000, and of that, $62,000 had been collected. If inventory represents Sylvan's only cost, calculate the firm's cash flows as of December 31st, 2006. Assume no taxes.
All right, so here the different cash flows for this case. Would be an outflow of how much? 85,000. So here cash flow will be negative 85,000. And then an inflow of how much? 62,000, right? Why? Because it is true that sales were $97,000, but only 62,000 were actually collected in cash, right? And then of course the rest will be in terms of accounts receivable, right? So therefore plus, did I say 62,000? Yes. So therefore, cash flow for this period would be negative 23,000.
Mm-hmm.
Right? So what about net income? So net income would be closer to what here?
12,000.
So it would be more like 12,000, right?
Yeah.
Do you see that? Yeah, because here, the entire sale will be considered as sales, right? So therefore, it will be 97,000 minus the 85,000 for net income. Next. Well, use the following tax table to answer. Are you okay with number 6?
Yeah.
You were not okay with number 6?
Oh, no, I'm not, I'm fine with that.
Oh, okay.
Yeah,
When you said no, I thought you were not okay.
I don't know that one.
7, so use the following tax table to answer this question. And then Pools Inc. has taxable income of $120,000 for the year. What is the average tax rate? So let's compute the taxes paid, right? Oh, the tax bill. Okay, so that will be the first 50,000 will be taxed at 15%. So I do 50,000, times 0.15 plus the next 75. The next 25,000 will be taxed at
25%.
25%. And then the next 25,000 again will be taxed at 34. And then now here taxable income is 120, so there's only an additional 20,000 left, right? And then that will be taxed at 39%. And then we add them up. So we're gonna add those terms, and then that would be the taxes paid, right?
Yep.
Tax due or tax paid?
It's paid, or taxes paid due, same thing, tax bill, That makes sense, either way is fine.
Yeah.
What's due, what's paid, So then I believe we get 30,050.
Yes.
So therefore, now we're ready to do the average tax rate, right?
25.04.
That's right, so then it will be 30, 50, like that, divided by 120,000, which is taxable income. And then you say we get what?
25.04%.
Okay? And then there could be another question after that, what is the marginal tax rate?
39.
39.
It's
39,
39%,
yes.
right?
Oh,
So that makes sense, that's even.
What's the what?
What is the marginal,
Oh, yeah.
marginal tax rate? Margin is the tax, exactly, tax is the tax paid on the next dollar, right? Of income, does that make sense?
yes.
Or the additional tax paid on the additional dollar of taxable income, right? Do you agree?
Yeah.
Good. Next. Now, what is the role of the financial system, financial market? What is the main role of the financial system or the financial market?
To match up savings with investment.
Investment, very good. To match up savings with investment. Or the main purpose or the main function is the transformation of savings into investment. And of course, investment is important because investment is the key to economic growth. Maybe you could write it down. And investment is the key to economic growth. Next. Who wants to read this one?
Caterton Co. had net sales of $750,000 over the past year. During that time, average receivables were $150,000. Assuming a 365-day year, what was the average collection period?
Very good. Now, what is another name for the average collection period?
Days in.
In receivables, right? Days in receivables, right? So can I do that here? Again, same thing. Here we could answer this question in 2 steps or 1 step, right? In 2 steps, you want 2 steps?
Let's do one.
1, right? The average collection period is going to be 365 over the receivable turnover. And that one, receivable turnover will be sales over accounts receivable. So in this case, it's, is it 750? Divided by 150,000. So then 365 over, now we can compute that receivable turnover, 5.
5, yes.
And then we get
73.
73
Yes.
days. Right? Next one. So far, so good? Yeah. Okay, next one.
Lemon Lyman Inc. has a
Lemon Lyman Inc. Yeah.
has a current stock price of $75. For the past year, the company had net income of 7.4 million, total equity of 32.445 million, and 4 million share of stock outstanding. What is the market to book ratio?
All right. So what is the market to book ratio? So this one is going to be a market measure, right? Like a market ratio. That make sense? Right? So book to market, right? Is that what it is?
Market to book.
Okay, market to book. Ratio is going to be the market value per share over
Book value.
book value per share. And then there, the market value per share is simply the same as the price, right? Which is here, is that 35? 75. And then I divide this by the book value per share, and again, we could do that in one equation. Now, what is the book value of equity here?
Total equity divided by shareholders.
That's right, so but what is the book value of equity? 32 million, 450,000, right? And that divided by how many shares?
4 million.
4 million. Right? And then we get 75 divided, and then of course we still want to get that number here, right? 8.111?
25.
1125.
1125?
Yes.
Okay. And then we ready to provide the answer, right? 9.244.
9.
Oh,
450.
Is it
9
50?
point, I got, what'd you get? 9.2?
9.24.
245? That's what I got.
I got 2450.
Oh, that, he was just rounding up. I see, I see.
That's all right. So what's the unit here? Times, right? Now times, because basically what that means is that for example, the interpretation there is that the market value is going to be 9.24245 times the book value, right? Okay?
So the book value is the total equity divided by.
Well, the book value per share. So book value, just book value equity is just the total equity.
So it already includes the net income that year?
Yeah, well, the equity includes, maybe not income, but additional retained earnings will be included in there.
So book value doesn't necessarily include the net income of that year?
Yeah, but again, so the equity here is really read on the balance sheet.
Okay.
But so you don't really have the net income there, but what appears is the additional retained earnings.
What is that?
That would
Yeah,
be-
if they paid out dividends, it wouldn't be all of net income.
That's right. That's why you only look at the additional retained earnings. So not all of the net income will be part of the, right?
Yeah.
Make sense? Next.
Donna's Donuts has total assets of $9.5 million and total asset turnover of 2.85 times. If the return on assets is 12%, what is Donna's profit margin? Show your work.
I don't know why I have that twice. Yeah, that means that I really wanted to show you. I wanted you to show your work. So what do we need here? So we're looking for the profit margin, but we give it information on the return on assets. And then we also have total asset turnover, so perhaps we want to use DuPont. Right? DuPont could work, right?
Yes.
Because DuPont says that ROA, so that's question
11.
11. So if we use DuPont, it says that ROA, which is net income over total asset, could also be written as net income over sales right, times sales over total assets. So basically, it says that we have profit margin, right? Times TAT, right?
Yeah.
Now, we know the ROA, what is that here? 12%.
12%. Yes.
So it's 0.12. We know that TAT is 2.85, right?
Yes.
So then our unknown here is the profit margin, right? And then we solve for the profit margin.
Okay.
Does that make sense?
Mhm.
So that profit margin will equal 0.12 divided by
2.85,
2.85. And then what do we get?
0.0421.
21 or 4.21%, right?
Yes.
So either you write it in percent or you simply write it in times, either way, right?
And for this, we could just, when you say show your work, all we need to show is the ROA equals PM times TAT, right?
Well,
We don't need to show the
basically-
part above?
Yeah.
Okay.
You could also have that one.
Okay,
At least this, you know?
yeah.
I mean, I did this so that you know where it came from, right?
Yep.
Okay. Yeah, next one.
Suppose you will deposit 20,000 per year in a bank account for 30 years and increase the annual deposit by 3% each year. How much would you be able to withdraw in 30 years if the discount rate is 10%? Assume the first deposit will be made at the end of the year.
Okay, so again, number one, is this a single cash flow or multiple cash flow? It is multiple cash flow, right? Is it unleveled or leveled? It's kind of leveled, but a growing one, right? Does that make sense? Now, it is going to be, what?
Excuse me, what does level mean?
Yes, what does it mean?
Well, level means it's a constant cash flow, or it is a cash flow that will grow
At
at a constant rate.
Okay.
I mean, that's how I define level cash flow. Either purely constant in the case of non-growing cash flow, or it has a pattern. The stream is growing at a constant rate, right? So clearly here, this is the case of a growing annuity. Do you see this? Is it the present value or future value?
Future
It
value.
is the future value because we're looking for the, the main question here is how much are we going to have at some point in the future, right? How much are we going to accumulate? Is that what it is here?
Yes.
Yeah. Or how much can you withdraw in the end? So now we know it is a future value of a growing annuity. So that the future value of my growing annuity, the first cash flow here is going to be 20,000, right? Times, and then the annuity factor, right?
Yes.
Which is, because it is a future value, so it's 1.03.
0.03. It's 0.03. Yeah, the point is.
It's a future value of a growing annuity. So it's 1 plus r raised to the power n. So therefore it's 110, because the discount rate is 10%, right?
Yes.
It's 110 raised to the power
30.
30 minus 1 plus g to the power n.
1.3.
And then the whole thing over r minus g, right? And then we're done, right? Obviously not yet, because we have to produce the final answer. Again, remember, when we have a growing annuity, we cannot, there is no financial key, right? So we're forced to enter those values into the calculator. So would you know how to do this? I gave you like the order of operation, right? So basically, I would do the 130, and then I would raise it to the power 30,
Yeah.
minus, and then I open a bracket, right?
Mm-hmm.
1.03 raised to the power 30, I close my bracket, right? And then I equals, whatever I get, I divide by 0.07.
7.
And then whatever I get, I multiply by
20,000.
20,000. If I do that, I get 4,292,000. 292,039
Yes, that's what I got. Okay.
Is that what you have?
Yes.
All right, so that means that you're doing it correctly. That was just practice, you know? Is that okay? Now, do you understand why we went ahead with future value of the growing annuity? Right, okay, good. Can you read the next one, please?
You expect to receive $25,000 at graduation in 3 years. You plan on investing it at 12.5% until you have $120,000. How long will you wait from now?
Okay, make sure you work below. Actually, this one, for this problem, let's use a timeline. Okay, this is what the timeline says. So this is to that. And then in 3 years, you are going to receive 25.
Yeah.
Right, and then you are going to save this amount until you have 120,000 at some point in the future, right? So obviously, one of them has to be like an outflow, and then another one has to be what?
Inflow.
That make sense?
Mm-hmm.
Because basically, once you receive your 25,000 in year 3, then you invest it.
Mm-hmm.
Okay? And then the question is, how long do you have to wait from today? So first, let's look for the number of periods between this period and this period, right? So it's a two-step process. So number of periods required to meet goal, right? So basically here, if we wanted to solve from n, so that 120,000, is that 120,000?
Yes.
Will equal the 25,000 times what is the rate?
12.5.
12.5 raised to the power n, right? So this is what we want to do. We want to solve for n in this equation, right? And then you use the calculator. Do you know how to use the calculator, Taylor?
Maybe not.
Okay, so now this is future value, this is present value.
Yep.
This is the rate, this is the time. But then we want to solve for time, so we said 12.5 is going to be the rate. Now, this is not an annuity problem, it's a single cash flow, so therefore 0 for PMT. My PV, negative 25,000. My FV, 120,000. And then I compute what's left, which is N. So then what do I got?
13.9.
317,
13.3175?
78.
7, 8.
Okay, let's say 3.2 then, right?
Okay.
And then, of course, the unit here is important.
12.
Yes.
Years, right? Does that make sense? It's years. So therefore, what is the waiting time?
16.36.
Very good. So it'll be the 3 plus the 13.32, which is 16.32 years.
133.
Right, because again, that time that we just got, is really from here to there, right? So that's 13.32, but we have to go 3 periods back, right?
Oh,
That's why we add 3.
okay. So it's like a little tricky.
That's right. So that's why I did the timeline, right?
Do we have to put the numbers and the future value formula, or can we just put it like that, the way you just wrote it up there?
You like here? Like that? Well, I said in class that you could write this and then solve for and using a financial calculator. Or you could also use the n is also the ln
Yes.
of 120,000 over 25,000 divided by the ln of 1.125. You could also do that,
Yes,
right?
I use that one. I use this one.
But I said you could also write it this way and then solve for it. As long as I see the equation with the values, of course, then I'm happy. And then you still get the final answer. Next.
Then it says net working capital of $950, liabilities of $4,370, and inventory of $1,900. What is the quick ratio?
So what is the quick ratio?
Current assets minus current, minus inventory.
All right, so it's the current asset
Minus inventory.
Divided by current liability.
Very good. And then, do we know the current asset here?
No.
Not directly, but we can get it with the, through the net working capital, right? So that we know it's going to be 950 plus 4370, right? Why? Because recall that net working capital is really current asset minus current liability, so therefore current asset is my net working capital plus current liabilities. And then minus the inventory, which is 1,900 over my current liabilities, 4370, and then we conclude. .7826 times.
Oh, times.
You said times, right?
Yeah.
Very good. Question 15 is what I did last on Wednesday, right?
Yeah.
What are the 2 types of amortization?
Constant payment, constant principal.
Very good. The 2 types, one is the a constant payment, or constant total payment, right? And then the other one is the constant principal payment, right? So constant total payment. And the constant principal payment. one thing for sure, at maturity, we pay off what?
All the principal.
All the principal.
So constant total payment is, that's the one where they amortize the payments and they're all the uniform
That's right,
size.
the payments,
And
exactly.
the other one, you pay the principal and the corresponding
Interest, exactly. Except that the difference is that the principal will always be the same.
Right.
The principal payment in the second one. It's always
So
the
is it-
same, and then
is
you
it-
only add up the principal for that period. Does that make sense? I'll just give you an example. Let's say that, you take a loan, and that it is 10,000. To be paid over, let's say, 10 years, right? One payment per year. And then let's say that the interest rate, let's say, is 10%. Okay? Now, let's use the constant principal. All right? So what do you think the constant principal would be
And for 10 years.
over 10 years? Maybe 1,000. Right?
Uh-huh.
My constant principal will be 1,000 because I want to make sure that I will reduce my principal by 1/10 each time, right?
Mhm.
So my constant principal is 1,000. So therefore, what is my first payment? Well, my first payment is going to be that constant principal, first total payment will be the constant principal plus the interest, right? But then your first interest will be based on a 10,000 principal. Right? So what is 10% of 10,000?
1,000.
What is it? 1,000. But then, going to the next period, now your principal is now what? 9,000.
9,000.
The next period, your principal is now what? 9,000. You understand what I did? The first period, your principal is 10,000. So therefore, you have to pay interest on the 10,000.
Yeah.
But your because the method says constant principal reduction, it has to be 1,000 because you want to be done after 10 years.
Mm-hmm.
Do you get it? So that my second payment will have to be, again, 1,000 because of my constant what? Principal payment.
Yeah.
But this time plus what?
900?
900. Why? Because now your interest is based on
9.
the 9,000, right? And so on and so on. Until you get to the 10th year. That's how I would do my constant principal payment, right?
Mm-hmm.
Now, for this one, if I wanted to do a constant total payment, then I would have to use the annuity formula, right? Then it would be this. I'm looking for my total payment so that the loan